Welcome, everyone, to the Main Street Business Podcast. Excited to be with you today for our live open forum. I mean, it's recorded. I know you listen to it recorded, but Mark and I are answering questions live between the two of us. I don't know.
There's no script. This is legit.
Yeah, unscripted, obviously.
Yeah.
Edit out a few dumb things we each said in every podcast. But thanks for being here. We are going to get into your questions. We've got a lot. And this is post-election day, so I don't know. Are you a little groggy, Mark? Did you stay up late watching it?
I did. I don't know why. Well, actually, I had lots of work to do, so I wasn't exclusively watching NBC. I'm a huge Savannah Guthrie fan. That's for you, Savannah. Have me on the show someday.
Yeah.
But
Arizona, University of Arizona graduate. You know.
Oh, I didn't know that.
Arizona girl.
Yeah. Yep, she's awesome. But I was up till 2:30, which was 4:30 Eastern. So I was on the cutting edge, but got 3.5 hours of fitful sleep, waking up to a new day, a new norm. Which do we even know who our president is yet? We don't know, do we?
Yeah, I know. By the time you're listening to this podcast, we may know, but there may also be a lawsuit. You know, this could be a Bush v. Gore all over again. Who knows?
Yeah.
Just a lot nastier and messier, probably.
Yeah. Well, I know all of you must be sick of politics as I am. So we're going to jump right into the issue at hand, and that is helping you make more money, save more money, protect it, live the American dream, find time to do what you love. And if you're a workaholic, we want you to work more. If you're a playaholic, we want you to play more. So we're going to just try to do it all. So
yeah, we just want your life to be better, you know? More of all the good stuff, less taxes. So, all right, now mainstreetbusiness.com is where you can enter in questions for open forum. We're getting the recording function up. And Mark and I have a lot from last week that we didn't get to and some that came in as well. So I wanted to give one update, though, from kind of the news, if you will. This is a good news from the IRS, actually. They don't usually report great things, but good news from the IRS. You can now put in $58,000 into your solo K or SEP IRA in 2021. So we're able to throw an extra $1,000 in per year. Hsa contributions went up, by the way, for 2020 also, up another $50 for individual and family. So I believe it's, 50 individual, 100 family. So that's cool. We're able to throw more money in for these saving strategies. Many of you listening use those accounts or familiar with them. You're going to be able to dump more into them next year. And I got my article up on it that's on Entrepreneur and on the Directed IRA site as well.
Yeah, and I don't know if many of you want to hyper focus on the limit of what you can put into a 401k. If you go to YouTube and type Mark Kohler Sweet Spot 401k, I talked about where you want to be based on your income, and just maxing out your 401k might cost you more in FICA than it's worth. And so it's an art. So between now and the end of the year, we are swamped. We really are. Any of you that have called the office, in fact, this is a good public service announcement to tell you, don't give up on us. We are hiring and training more attorneys. We've got great accountants and paralegals here as well. We know many of you need a consult before you're in. We're going to do our best to make sure all of you get the advice you need to make some strategic decisions. So we'll make it work.
The only thing I was going to add with that too is on that, the Solo K special is now rolling. And we're setting up those solo 401k plans at Directed IRA, at KKOS Lawyers, and then the accounts are over at Directed Trust Company, Directed IRA. So get to KKOSlawyers.com where we have the special page going now, and you'll be able to sign up and get going on your Solo K. Because if you want to contribute to a Solo K for 2020 contributions, you're looking at tax planning. As we're doing these year-end tax consults, one of the number one areas where you get big tax deductions and keep your money is Solo Ks for self-employed people. We set up hundreds of them at year-end, and we're doing the same. We offer a special to get it done in November. But you got to have it set up by year-end in order to make 2020 contributions. Even though you can put the money in later in February or March, later on in the year. And even if you file an extension, you get to the extension deadline, you must have the plan set up in the plan year.
And this, by the way, this is the show. Today is our show where we just answer questions. And I think I want to pose a common question we get on this very topic and kick off our rapid fire Q&A session on what the difference is between a 401k and a SEP, and what are some issues to consider between now and the end of the year. Big topic. We could spend the whole show on this, and we probably will have a show on this very topic. We were talking about literally next week or in the month of November when we're doing the special. So, but just food for thought. And Matt, I'll give my quick take. You tell me yours. Is the solo 401k, and I want to be really clear about what Matt just said. You don't have to put the money in till next year. Yeah. But you have to designate what you're going to write off and what the deduction is going to be this year and get the plan in place. The IRS says, oh, you want to do a 401k and you have no other full-time employees except you or family members? You can do it. Get it set up. Tell us what you're going to defer. And then you can put the money in up until September of next year, literally. So you got lots of options there. But if you don't get it set up before year end, you're out. That's my first major point. Matt, what would be another significant point on this strategy, you'd say?
Well, I mean, of course, you can self-direct. That's one of the things I always want people to know is it's a tax strategy, but it's also an investment strategy. So I want to be able to throw the money in as a tax strategy and get some deductions if I'm going traditional, but it could also be a long-term investment and growth strategy and be able to invest in what to grow it to be a greater, larger account at the end of the day. And that's, of course, what many of our clients know us for is self-directing. And we have our own separate directed IRA podcast to learn more about that. And we talk about it on this show too. There's questions in the open forum today about it. You just can't get around that topic. But that's one cool thing. And many self-directed investors, most of our solo K clients self-direct. They buy real estate, they invest in alternatives. They're not just buying stocks, bonds, and mutual funds, although you can.
Yeah. And that sounds good. I'll have one of those. But that's from Dumb and Dumber.
I'll have that, yeah.
I'll have that. Now, let me give a quick example, everybody. And this was a phone call I had this morning, personal planning note. Now, I want to be careful not to disclose too much here. Can't make my life a complete open book. Many of you would be very, I'll leave the jokes aside. Anyway, I was going to make some more jokes. This morning, I had a phone call. We're looking at buying a building for one of our business operations. And I'm not a majority owner in that business operation. And so, since I'm not a majority owner, I could own a minority portion of that building and in my 401k. And so I was talking to my business associate and I said, hey, did you make an offer on that building? And Matt, as an aside, he did. And I said, great. I want a piece of that. And he said, well, what's your plan? And I said, I may just take a $15,000 stake in the building and I'll just do it through my 401k. So I might contribute in the next 6 weeks into my 401k. Now I don't have to until next year, but I could. So I want to make sure that my 401k has an extra 15 grand in it in the next 6 weeks. And then on day 2, I call directed IRA and I go, hey, that 15 grand in my 401k account, send it over to this LLC bank account and we're going to buy a building. And I might be a 10% owner. I might be a 5% owner. I don't know what the 15 grand is going to get me. But the beauty is I know it's a building that has a great tenant, me. And I know tenant's going to always pay the rent. And I can do this and it's not prohibited. And by the time I look at appreciation and mortgage reduction and tax benefits and the cash flow, I'm going to be well over a 20% rate of return on that 15,000. So why am I going to go buy an ETF or a mutual fund? I'm not going to get 20% year in, year out. So that's just a little personal example of how powerful these little 401ks can be. And if you have the right type of group 401k, you can do that. Or for many of you that don't have full-time employees, you can do the solo. So
yeah, cool.
You endorse that message, Matt?
I do endorse that. I love that message. That's That's my message. So
Since
amen.
since half the commercials you hear in Arizona are, my name's Matt Sorensen, and I endorse this message.
Oh my gosh, this is the one great thing about the election being over. My phone, we've been battleground state that went for Biden apparently, as far as we know so far. I guess they've called it. And I mean, anyways, my phone has been blown up. I'm so over it. So, all right.
Okay, now I want to say one thing about the SEP, because I threw that out.
Okay.
Now I have a YouTube video on this as well. Matt and I have a 401k SEP video on this on our special page. So when you go to the special and go, hey, maybe I'll do this solo 401k. Matt and I have 6 videos free that you can watch and go, this may be a good fit for me. So get a bowl of popcorn and Diet Coke and watch those videos. I think they're, they could be Oscar-winning videos. I'm just going to throw that out right there.
Mm-hmm.
But the SEP is really crappy from a tax write-off standpoint because it's 25% of your net income. Or if you're in an S-Corp situation, it's 25% of whatever your salary is. Well, with the 401k, you get $19,500 this year plus 25% of your salary. And if you're over age 50, you can even get more. So it's almost like being in a race. You want a 19,500 foot head start? That's what's cool about a solo 401k.
Yeah.
But if you've hired full-time employees this year, you've got to include them in the plan. So you can't do a solo. So that talks about a group 401k. It's too late to do a group this year. Touch base with us in January, February. We'll hope to, help you through a self-directed group plan possibly, if that's a good fit for you. But what's nice about the SEP is if you haven't had a full-time employee for the last 2 years, so let me say it this way. If you have no full-time employees that have been with you as of 2 years, for 2 years, as of December 31st of this year. So say you hired a full-time employee a year and a half ago. Have they been with you 2 years? Nope, only a year and a half. You can do a SEP and you don't have to include any employees. But once they hit the 2-year mark, you got to include them in the SEP. So what do we do at that point? Stop the SEP. Because it's bad when you have to start including employees. So for any of you out there, they're like, I'm kind of on the bubble. I've had some full-time employees, but they haven't been with me 2 years. I want to do a solo, but I can't. I got to wait for a group next year. Ooh, I could do a SEP. Cash in on at least a decent write-off, better than an IRA for sure. And then in the spring, move the SEP into my 401k. So I love that strategy. Matt, anything you'd add to on that?
Yeah. In other words, let me say it another way. If you have a full-time employee, which is 19 hours or more, you can't do the solo K because it's not just you anymore. You have to include full-time employees that have worked for you for a year. Now, the SEP, though, gives you a little 3-year window, actually, which is nice. So now I got up to 3 years where
Was it 3 years?
Yeah, it's 3, which is a 2-year difference.
Gosh.
It's a 2-year difference from the solo. So you actually have up to 3 years. So you might be able to get away with an extra 2 years of contribution in the SEP over the solo K. So that's
over the IRA. That the beauty of that is it's better than an IRA, and you don't have to, and you can't do a solo. So it's kind of this sweet spot again.
Right. Yeah. And we have some clients that qualify for a solo and don't have employees and still do a SEP because it's easier, it's more simple. It's still the amount of money I want to put in every year is I qualify for. I'm not hitting the max outs. And that's cool. They're getting their 10 or 20 grand a year based on what they're making, and they're happy. That's the savings they want to be doing anyways. So just because you can max out doesn't mean you should. Everybody still has their budget of what they want to set aside in their plan. So, all right.
On an example on that, I was at the gym on Saturday. I had a sparring session, 2 3-minute rounds against another heavyweight. I'm a heavyweight. I'm over 200 pounds.
That's the heavyweight category, huh?
Yeah, so I'm a heavyweight, and this other guy, he's a heavyweight, and he's tough. But we go 20-30% on each other, and we started to get a little. You get a little adrenaline going. Yeah. And he started throwing some harder punches, and I was like, I kind of almost got knocked, not knocked out, but I was reeling, and I was like, and his name's Mark, by the way, and I'm like, Mark, dude, you gotta bring it down a notch,
We're going to step it up for him, No?
Yeah, I was going to bring it back, but I was going to bring it, but this face, this is all I got, and I can't have a black eye,
You only get one of those.
Yeah. So
that's the moneymaker.
Yeah. So he said, well, let's go lift weights after. And he threw up 2 plates. That's 220. That's what they do at the combine. You see those guys
Yeah,
on the NFL
225,
combine,
yep.
they're just like,
Yeah, they'll do like 50 reps. Yeah, 225.
Yeah. And I could do it. But just because I could do it doesn't mean I should, because I'm going to pull some muscle. It's not going to be pretty. I would be in traction. So
yeah,
sometimes as guys, we get in the gym and we think, yeah, we can do this, but it doesn't mean you should. And so that's the same thing with maxing out a 401k or a SEP. Just because you can max it out doesn't mean you should.
Yeah.
I thought was that not a good analogy, Matt?
That was a great analogy. And you also got a drop in there that you boxed and that you can bench 225. So for any of you ladies out there, he's married, okay, he's taken. Yeah, for
all right, ladies out there, since Matt's going to throw down, Matt is not taken. So you can send all of your love mail, all those care packages to care of Matt Sorensen. Send it to me and I'll sort through them. And then I'll see,
Okay.
I'm kind of his representative. Okay. I got a first question here, Matt. You got a good one? I got a good question.
I do. I have a good one, but you go first.
Okay, you go.
Okay.
Is yours an IRA 401k one?
That's PPP.
Oh, it's PPP? You do it. I got a charity question. Okay, you do the PPP.
This is from Brandon that came in on Facebook. He asked about the IFR, asking, does the IFR allow me to still request forgiveness of my PPP loan, even if I don't have the same number of employees?
Okay, tell everybody what IFR is.
Okay, IFR is the interim final rule. And this is what he's talking about. Mark and I have talked about the new app for forgiveness for those that have PPP loans, Paycheck Protection Program loans of $50,000 or less. It's a streamlined, easy app, no calculations. Basically, put in the number of what you're asking to forgive, how much you got in a loan, attach your paperwork showing you paid those things for payroll or other qualifying costs. You're done. Okay, you could do that app in 15 minutes if you really actually paid the money. Really easy. Now, if you remember, there's this rule under PPP that said, hey, if you don't keep the same number of employees you had pre-pandemic to when you got your PPP money, we're going to reduce your forgiveness amount by the percentage of your employees decrease. So if you only kept 60% of your employees, you're only going to get 60% of your PPP loan forgiven.
Very well stated, Matt.
Thank you. Thank you. That's a good. Quick summary. It's a technical rule, but
I understood.
Okay. All right. Okay. Thank you. And now here's the curveball that kind of came up, which was, I shouldn't say curveball. Here's the soft pitch that the IRS threw out, or the SBA threw out. They said, you know what? If it's under 50 grand, we don't even care. If you're someone that got PPP under 50 grand, even if you had an employee change, we don't care. As long as you still spend it on qualifying costs, we don't care. We're not going to reduce your forgiveness request. Knock yourself out. Do the easy forgiveness app. I should say the simple app. There is a separate easy app to the simple PPP app. Don't worry about employee change. So for those of you that were 50 or less, that may have had an employee or two, or so that dropped out of the mix, you don't even need to calculate it in. As long as you spend enough during your 24-week period now, you're good. So that was a good thing Brandon brought up, because that came up on our podcast and our entrepreneur webinar on it. And I don't know where the IFR was at on that, but that question came up of employee change. But for those 50,000 or less, smooth sailing. It's good news.
I like it. And it's kind of the interim final rule is kind of like we're projecting Arizona to go with Biden. And they did the new one. We're leaning towards it. We're not projecting. We're leaning. I was like, seriously?
Yeah.
Anyway, but so an interim final rule, you're like, what the freak is it?
Yeah. What's the interim final? What's interim final? Like,
which one is it? Proposed or final? I'm getting it.
This is the final halftime show. The halftime, what?
The interim final rule is kind of like where you go to mom and mom says, yeah, you can stay out till midnight, but it's only interim until you get the final word from dad,
That's right. And so just don't ask dad, just go.
Just go. Yeah. Forgiveness is much easier in that situation. Just ask for forgiveness later. I will say this on the PPP. If you've got a Paycheck Protection Program loan of less than $50,000, it is not automatically forgiven. That is proposed legislation. We still don't know if it's going to happen. They're trying to the proposed legislation is anything under 150 grand, but that's not done. So you still have to apply, but for those under 50,000, like Matt said, easy schmeezy. It's a very simple application. Matt's got an incredible article on this. You can find it on our blog. I'll be updating it in our newsletter in the next 48 hours. So make sure you've always signed up for our newsletter. And you can go to mainstreetbusiness.com to sign up for the newsletter. You get a couple of our ebooks for free. I think you'll find those really helpful too. All right. This is a question from Kevin via email. Oh, I've read that you can take an item. Okay, he wants to donate inventory to a nonprofit. Okay, so maybe it's Thanksgiving time and you're like, I've got all this canned food on my shelf. I'm going to take that canned food down to the soup kitchen and I want to donate it. And he says, what's my write-off? And he said, I've read that you can take an item that you would normally sell for $300 and multiply it by the amount you donate. Only if we could wish it so, Kevin. Bless your heart. The instructions in publication 561 are confusing to me. That's because you're reading an IRS publication. If you can't sleep at night, everybody just pull out an IRS publication.
Yeah.
Knock you right. Yeah. You'll have nightmares all night, but at least you'll go to sleep.
Okay. And it'll bum you out.
Yeah. You'll be bummed. Okay. So he says, if I donate 60 items at $300 each, that should result in an $18,000 deduction. How do I account for the $6,000 cost of inventory with that calculation? So apparently this inventory only cost him $100, but he would normally sell it for $300. So I'm going to go back to my cans of soup, and because I think it's a little easier visualization. And so if I'm going to take down these cases of soup that I bought for $100 and I normally sell them for $300, if I take this case of soup down to the soup kitchen, what's my write-off? It is your basis. It is what you paid for it. So I can only deduct what I paid for. You do not get the fair market value deduction. You get the basis deduction. Now, if I'm wrong, and I don't think I am, but
yeah,
Kevin sounds pretty adamant in his email. So I'm going to reach out to a couple of my.
Well, there are, let's say, certain assets I think get treated different. Because let's say you bought real property for $100,000, it's now worth $1 million, and you want to donate that $1 million real estate to a charity. Well, you get a charitable deduction based on the fair market value, actually. Same thing with appreciated stock. But I think for personal items like those, I don't believe you can take a fair market value approach. I don't know though, but I presume there's going to be a lot of abuse for that.
And so I'm going
how do you fair market value those items? Are you getting an appraisal on those things? And can you buy them for 100, but they're really worth 300? Like while that may be what you could sell it for, it's probably not the actual true fair market value. You bought the fair market value.
I'm making a note. I'm making a note right now, everybody. Charitable donations of product or property. What's my write-off? That is going to be my blog article tonight. What's my write-off? Now, I'm going to tell you right now, my gut feeling from doing this many years, and I could be wrong. There's a lot going along in this head, and it gets hit with boxing gloves once in a while, and it's pretty much clogged with malted hops and bong resin. But that's from Tommy Boy. And but my opinion would be, if I was taking an exam and you had, this was final answer, Jeopardy, I would say the deduction is your fair market value or basis, whichever is less. So if you paid $100 for this stuff, you get $100 deduction. If it's only worth $50 because it's crap, you get a $50 deduction. Now, the problem is you're saying, well, it's worth $300. Well, who's to say it's worth $300? That's what you sell it on your shelf for. Yeah. That's not a bona fide appraisal. It's just inventory on your shelf. So that's where Matt goes from what's called real property donations to personal property. And so personal property, if you go down to the Salvation Army at Christmas time and drop off a bunch of crap, it's the fair market value of the items or what you paid for them, whichever is less. So I will confirm that, and I could very well be wrong. So if you So there, you know,
All right.
just get you to read the newsletter.
Yeah,
You might
nice. I
want
like
to find
it.
out.
Yeah, well, yeah, you gotta read the next chapter.
Yeah.
I feel like that's in like I'm just watching Game of Thrones now. I got sucked into Game of Thrones.
Is it good?
It's pretty good. I'm in season 2 now. Now I see why everyone was talking about it the whole last decade. I'm like, I get it. I see now. And that's every episode ends on this cliffhanger where you've got to like watch the next episode to see what happened. Just like,
Breaking Bad, baby.
Just like your charitable deduction question there. Okay, I got a question on a client selling property in an IRA, and then losses here, if you don't mind. This is from Chris in Park City. He said his father sold an investment property that was held in his IRA in May of 2019. He sold the property for $141,000 and had been purchased for $160,000 10 years prior. So he had a $19,000 loss essentially on the property. He was under the assumption, based on some bad advice he got from someone else, that they're about taking the loss. Which, let me just say, when your IRA buys property and sells it for a loss, you don't get to take the loss. Whether you bought stock that you sell for a loss, you buy real estate and sell it for a loss, you don't get to take the loss on your personal return. Just like the IRS doesn't make you put the gain on your personal return, okay? It's like if you buy it for a gain, you don't have to pay tax on it, right? And the IRS doesn't make you go throw that on your personal return. So you don't get to carry the loss over onto your personal return. He said now they're going to basically distribute the proceeds from the sale of the property, but they're going to pay taxes. They're on a fixed income and a budget. What strategies do they have to minimize the tax, essentially? Well, the first thing is taking the distributions over time. You don't want to drain the whole 140 grand or whatever it is in 1 year. That's going to push you into a higher tax bracket than you'd otherwise be. And so the first advice is take the money out only as you need it. All right. The second is if they're like, well, they need all of it. Well, we're at the end of the year here in 2020. Take half of it maybe in 2020 and half of it on January 1st, 2021. That'll break it up between at least 2 tax years. So you get maybe 70 grand on 1 year, 70 grand on the other. But otherwise, I would just say take it as they need it to supplement their income in retirement. Don't drain it all at once and then pull it out of a savings or other account. Keep it invested. Try to keep growing it, of course. That's my advice there for Chris.
Okay, I like it. I'm already replying to a client that sent in a question. And Marilyn, she's a longtime client. We love her. And so we are going to, I want to tackle both of these here. So Marilyn says kitty tax deduction. First, Marilyn, there is no such thing as a kitty tax deduction. There's a kitty tax, but there's not a kitty tax deduction. So that's just point number one.
Is this for is this like the dog tax? The dog tax deduction?
Yeah.
All right.
I know. I'm currently working with
guys, a tax joke, guys. All right. Work with me. Work with
me.
Yeah.
I know. I'm currently working with
kids,
a
by the way. Not kittens. This is for kids.
Yeah.
All right.
She says, I'm currently working with a CPA that is not allowing us to use the $12,000 FICA exempt payment to our minor child. Again, Marilyn, that does not exist either. There's no FICA exempt amount for $12,000 for a minor child. I'll come back to that. Our structure is that we pay our Taylor family management, so they have a little Schedule C, and from the S-Corp, then we pay the minor child to her separate bank account. Love it. Been teaching that for 20 plus years, stand behind it all day long, put my license and my credibility and everything on the line, not a problem. That's how you should do it, Marilyn. In 2018, Taylor Family Management was filed as a Schedule C under my husband's social security number. In Part 1, the CPA listed the $12,000 as income, and in Part 2, the expense was listed as outside services. Perfect. And Marilyn, I know who you used in 2018, and they were completely right and accurate. Now you've changed to a CPA that doesn't know what they're doing. Now, why you changed, I'm not sure, and that's okay. Text me, let's talk. But this new CPA does not know what they're doing. So there is no mention of the minor child. That's right. There should be no mention of the minor child on the 2018 return. My current CPA insists that the above format was dead wrong and that we could be opened up for an audit for all years we have paid taxes. Well, an IRS can open an audit for as many years as they want, actually up to 6 years, more if they think you've been fraudulent. This is what he said would be required to take the deduction. The S-Corp should have 1099 Taylor Family Management. Okay, I'm fine with that. You want a 1099, a sole prop that you own? Great. Feel free. The penalty is about, I think it's 50 or 100 bucks if you don't. And issue a 1099. That's fine. Number two, the Schedule C should have its own EIN. No, it shouldn't. It doesn't have to. Hold it. You're telling me, Marilyn, that if I go out and open a lemonade stand, I have to have an EIN? I don't. I can open it under my social. Oh yeah, but then the company down the street came and bought a bunch of lemonade from me and they're going to 1099 me. Do I have to have a tax ID number? No, I can still use a social. Never heard of that. A sole proprietor has to have an EIN. You really want to Google that one, Marilyn? You know that's wrong. Okay, number three, the sole proprietor should have W-2'd the minor child. Absolutely dead freaking wrong. They can pay any child in their family in a Schedule C. Matt knows I'm fired up. In a Schedule when you pay your own dependents under age 18 out of a Schedule C, you are not required to issue a W-2. Have your accountant listen to this podcast. Oh, but Mark, there's a penalty if you don't. Yeah, there's a penalty if I don't issue a W-2. What's the penalty? It's a percentage of the FICA. Oh, there is no FICA withholding on my own freaking child under age 18. So in effect, the IRS, as I've interviewed many IRS agents on my podcast and over the years, and we have helped clients that have come to us in problems and in IRS disputes, talking with the IRS over years, and all of my study as a CPA in 6 states and an attorney in 2 states, you never, ever, ever issue a W-2 to a child because there's no FICA withholding. Thus, there is no, in effect, penalty. End of story. Dumb. Don't waste your time. The end. Sorry, guys. I get so upset. Finally, the minor child should have filed a tax return for every year she was paid. Wrong. In the United States, if you make less than $12,400, now, Marilyn, you said there's a FICA exemption of $12,000. No. Well, what I think there's been some confusion on is in the United States this year, the standard deduction for a single individual is $12,400. So if your kid goes and works at McDonald's and earns $12,399, they do not have to file a return because the standard deduction is $12,400. So it's perfunctory, meaning if you did file a return, you wouldn't owe anything anyway, and hence there is no penalty. So hence, why do it? Hence, you don't have to. Now, the FICA exemption that you might be referring to is when you pay a child of yours under age 18, you never have to withhold FICA for any amount. Marilyn, if your child earns $40,000 working for your company and they're 17 years old, and I've had clients do this, their child is a licensed realtor at age 17. They paid him $40,000 in commissions out of their sole proprietorship. There was no FICA withholding because it's their own child. It's not $12,000. It's not $12,400. It's any dollar amount you pay your own child under age 18. There is no FICA withholding. The question of whether they file a tax return is, did they make more than $12,400? Well, if I paid my kid $40,000, you're darn right they got to file a return because they made more than $12,400. Totally separate issue from FICA. So I sent an email to Marilyn. I said, just for fun, I will do it while I'm driving home. For 10 minutes, I'll get on a phone call with this accountant if he wants to get into it. And after they listen to this podcast and they do some research, go to Circular E and you'll see all this. And Circular C's, sorry. They go research this. You will find that I'm exactly right. We have been doing this for 20 plus years. If you get audited for Marilyn doing it the way I just mentioned, and we sign your return, not some bozo that's giving you a hard time. If we sign your return and do it this way, and there's any penalty, I'll pay it because there won't be any. And that's in writing all day long. Whew. Matt, I'm sorry.
All right. The dragon has been,
Unleashed.
Awoke the dragon. Maryland's CPA. And I'll say this. Lots of many tax planning savvy CPAs do that strategy. It is not like a weird one.
High risk.
It's common. It's
Yeah.
very common, actually. Okay. Let's jump in. I had a question here from Seiko regarding, says, beginning investor here. Someone told me the investor often rents his own residence to his or her own business to create a business activity. So putting your own residence in an LLC as you are a homeowner, rent part or the whole property to your business. Is this a legitimate way to create business activity for the purpose of building your business credit? Ooh, okay. No, I don't know. I do not like that. You're basically you're trying to make something up, really, is what you're doing there. Okay, so you can't just say, well, I own a home, let me put it into an entity and call it a business and pay rent to myself for having the business in here. There's no business, okay? Like, you can have a business in your home, a home-based business. You're selling goods or services, you're getting consulting income, or you're making money doing something. But this idea of, I have a business because I own a home, and that home is in an LLC, and now I'm paying rent to live in that property to my own LLC, does not make any sense to me. It would be a tax logistical gymnastics event that would eventually end in a painful injury. And I mean, from a tax standpoint. So I do not love that strategy. Sounds like someone trying to get a little too creative to create some type of business history for business credit purposes. I don't know. Have you ever heard that one, Mark?
No.
Okay.
Yeah.
All right.
Yeah. Okay. All right. Next question. This is from Lee in Midland, Texas. Longtime listener.
All
Love
right.
Lee.
Good
He
old
always
Lee.
he tries to stump us on a regular basis.
Yeah.
And this time he sent a picture of he and his boys out water skiing. And Lee, you look good. I'm just going to say that right now. You know, the little man crush. You're looking great out there. I love it. He says, hi, Mark and Matt. If I sell a house to an investor and owner finance it for them, does Dodd-Frank's rule apply, or is Dodd-Frank just for homeowners that are going to live there? I'm not sure if I even could break down the Dodd-Frank's rule in this scenario. Do you know, Matt?
Wait, did Lee live in it, or he just bought it for an investment property and seller financed it? I think the rules for Dodd-Frank are going to be different, and there's also be a volume issue there. If this was your own residence that you then sold an owner finance, no, don't stress about Dodd-Frank. Dodd-Frank is this set of lending laws that came in after the mortgage collapse. There's a bunch of regulations that came into apply to stop the banks from, going belly up because we had to bail them out. The dumb thing about Dodd-Frank is they made it so big that the little real estate investors selling properties, seller finance, are treated like large banks that are too big to fail. And so we have this nasty set of laws that can apply to even small investors. So
now, is that the case, Matt? Because I'm just pulling up some of the provisions of Dodd-Frank. It says every bank with over 50 billion in assets has to do an annual stress test. That's
a different part of Dodd-Frank. Dodd-Frank's
it's a long rule.
Dodd-Frank's like as big as a dictionary, So that's surface level stuff on Dodd-Frank. So yes, Dodd-Frank will definitely. A lot of private lenders have to deal with it. Now, the biggest issue, what I'll say is, and this is for anybody that, like I said, if you're selling your own home that you lived in, that was your residence, don't stress about Dodd-Frank. If you're an investor, though, buying rentals or other properties, and your strategy is to sell them to other individuals who are actual homeowners, so that you kind of fall into being like a mortgage lender, lending to someone buying up their own residence. Now Dodd-Frank may apply to you. Let's say, on the other hand, though, you're a private money lender and you lend money to just other investors. It's other LLCs you're lending money to. Dodd-Frank is going to be less likely to apply to you unless you're doing a lot of those types of loans. So everybody falls in a different bucket. I'm not sure in Lee's, if this is for investment purposes, Lee never lived in this house and seller financed it. He may be running into Dodd-Frank actually, and might have some requirements on that. Kevin in our office has done some lending law projects. Jerem has. I did back in the day, but I only do self-directed stuff now. So if necessary, we could research your specific situation. Or there are some Dodd-Frank lawyers we can refer you to if needed to.
Yeah. My general answer would be, and this is kind of what I tell people for good or bad in a consultation, is if this is an isolated sale, it's your own home, it's once in a while, and you're not in the business of financing, the business of lending, you're not in the business of acquiring properties, and you don't have a bunch of notes that you're generating when selling properties, Dodd-Frank's not going to apply to you. That's kind of my general rule. Do you think I'm safe saying that?
Oh yeah, especially if it was actually your residence that you then sold. Yeah.
Okay. All right. Okay, Matt, I've got a 403B question. You ready?
All right.
Ooh-wee. Okay. This is from Suzanne. She says, I had a loan that I took out on a 403B account in August of 2018. It was to pay for some education and also pay down on some high credit cards.
Okay.
Okay.
Usually a good reason to take a loan. Got it.
Not a bad one. Yep.
Two good expenses there.
Yeah. The better than a withdrawal. I get very, very concerned when people pull money out of a 403B or 401k or IRA, pay penalties and tax to refinance or pay off debt or this and that. Not a good idea. I like the loan, pay interest back to yourself. Thereby, you're not sacrificing the future value of your retirement account. In fact, you're your best borrower again. You're going to pay yourself back. So, okay. You agree with that, Matt? You're good?
Totally.
Okay. I paid on this for about 21 months. It was a 5-year loan. I paid down about $21,000. God bless you. Good job. That's very good, Suzanne. I spoke to a rep with the company, I don't know which company, early June of this year and thought he had used what was still in my 403B to pay off the rest. What I recently found out was he only stopped monthly payments. Late July and August, I had to take a COVID hardship withdrawal on my 403B due to losing my job on June 1st. I'm so sorry. Unemployment did not kick in until late September. This amount was 50 grand and I did the 10%. So I received 45,000. My question, would it be in my best interest to pay off the 21K from what's left in my account or try to resume payments? Also, I realize I will have to pay taxes on the 45 grand. What are your thoughts on this? And by the way, I'm 62 and 4 months old. Not sure if that would have any bearing. Now, Matt, as you gather your thoughts, can I say one thing? First, Suzanne, this is a very complex question for an open forum show. For me to analyze this question, I would really like to see the big picture. You know, what's your home value, your equity, married, single, how much is in your other retirement accounts, how much you're getting in Social Security, what's your debt load in other areas, because the questions you're asking are part of a bigger wheel. This is a cog in a bigger wheel. And so to answer this question in a vacuum, and albeit very complex as well, you're bringing in COVID or the CARES Act and just basic good retirement loan scenarios. I'm going to say that as a general rule. I don't know if I could even answer this on the show satisfactorily without having more of the picture, but that's just me. Matt?
Exactly right. I mean, my answer is going to be, it depends, and it depends on all those factors Mark just highlighted. Other retirement accounts, equity in your home, other assets. Are you married? I didn't catch that. Do you work and do you like working? Are you like, I don't want to work anymore? I mean, if you started taking Social Security? I don't know. So let me say it this way. If you're like, I don't need the money right now, it's just financially, as a general standpoint, I have enough left over, unemployment's fine, I look forward to being back in the workforce, or I am already now, and I'm going to be fine in the short term, I would pay the 401k loan back off and use that 21 grand to get it paid off, get the money back in so it can be invested and continue to grow. Because let's face it, a lot of people are retiring at 65 anymore, or 64 and 4 months. So you may want to get that money reinvested, let it keep growing back in your 403b or other retirement account, whatever you try to get it, but you'll get it back in the 403b if you do it, you're repaying the loan. But that all depends on other financial situations. If you're in financial hardship still, I would wait and sit tight on it. But again, depends on your situation. The nice thing with the loan and the CARES Act is it gives you options. And you have other payback options if necessary, particularly under the CARES Act distribution.
Yeah. And my final note would be, Suzanne, your head's in the right spot. Your questions are very, very accurate. There's nothing, you're not making any wrong assumptions. I think you've got a good handle on the situation, and the CARES Act could be a big savior to you in this loan situation that you've got going on. So I just think you need a consultation with someone that for an hour, maybe a half hour, possibly, but for at least a good half hour to an hour, and just break it down. This would be definitely one of our more seasoned tax attorneys at our office. That we bill them all at the same rate. But Matt, which attorney should she probably get with?
I think Devin, Jerem, Kevin, Christy, they're all good on this. This is Lee. That's
okay. All right, Suzanne, that's where I'd go. And folks, we're out till about Thanksgiving or shortly thereafter. So call now to get your appointments scheduled between now and year end to get your planning done. And Suzanne, I'd recommend the same, or get with your personal accountant if you have one that is savvy in this area. Yeah. Okay, we got a question from Nate in Pensacola, Florida, where his vote actually mattered.
Oh, yeah, okay.
That's a big deal, dude.
Hey, mine mattered too this year, finally. You have to deal with the annoying text messages and phone calls. In Idaho, you guys are in the tank for Trump, so you don't get any love from anybody.
No, but it's exciting up here still in other ways. Okay, now Nate down in Florida says, whew, okay, now this is a good question for a lot of you small business owners. I think you'll appreciate this. I'm a 50% owner in a small business, and besides the two owners, we have one full-time employee. Okay, so we've got a business, two owners, 50-50, and one full-time employee. Our two owners each take a W-2 salary and also dividend or pass-through payments for income. So it sounds like the way you're talking, Nate, you're in an S corporation. Not something I'd recommend with two owners that are 50-50 unless you're husband, wife, or close family members where you can play with some tax strategies. Because when you're both in an S-Corp, both taking a salary, and both taking a draw, tax deductions at the personal level for business expenses become very, very difficult. So you may already know that. That's a chapter in my tax and legal playbook. And this is a good time of year to maybe restructure that as of January 1st, 2021. But just a thought. Okay. Now it takes even a more unique turn. He says, we currently provide a dental benefit for our employees. So I'm assuming the two owners and this one full-time employee, they have some dental insurance of some sort and are looking to change to something else. We don't offer any health insurance as an employee benefit for all of us because we all have our favorable arrangements in place. Our employee has their own coverage with a spouse, and my partner and I are on healthcare sharing ministries, one of those ministry deals. So he says, ideally, we'd like some sort of combo dental and retirement account, as one of our owners is an empty nester and doesn't use the dental benefit as much as the other owner with 5 children. Now, what Nate just said is exactly why I just said 30 seconds ago, we do not like S-Corps for two partners. Because look what's happening. One partner is an empty nester, the other one, spouse and 5 kids. They've got different needs, different tax strategies. One wants retirement, one wants dental benefit. I bet you the guy with 5 kids needs dental insurance. The empty nester's like, I want to sock money away from retirement because I'm looking down the barrel at an ugly situation. Yeah. Okay, so he says, we're trying to find a combo of the two. It doesn't exist. It doesn't exist. So Nate, you and your partner need to pony up and get with a tax lawyer type advisor. That's us. If you don't like us, it's fine. But find someone that can talk about health insurance and dental insurance and tax strategies and retirement accounts and an S-Corp with 2 partners and a full-time employee. Woo, lots of moving parts, right? So what do we do? Well, I'm going to give just a short, quick, brief answer. You do what's called a corporate reorg. Sounds expensive, but it's not. In the next 6 to 8 weeks, you do a reorganization of your structure. You're a corporation and you're restructuring. Hence, corporate reorg. Very affordable. What we're going to do at the end of the day is end up with an LLC as the partnership, and each of you have your own S-Corp. Now, you and 5 kids can run out and buy health insurance, HSAs, HRAs, dental insurance, whatever the freak you want in your S-Corp, and probably not have any problem with this other full-time employee that you might take care of at the partnership level. The other partner with their S-Corp is going to say, screw that. I want to go do this 401k thing that Matt's talking about, or maybe a SEP. And we got to think about this full-time employee floating around in the group.
Yeah,
but
that's another wrench in it. But
that's another wrench. But there's probably some workarounds like we talked about with the SEP. But the point is, each partner can do their own planning when they each have their own S-Corp. Right now, you're trying to find a silver bullet because you want to stay one S-Corp, 3 paychecks. There's got to be some solution for all 3 of us. No, I'm not aware of one.
Funky.
It's funky.
Yeah, and that's, the problem is you have to do the same thing. That's the problem, what it boils down to. And you're wanting to do different things. Yeah, where you're at now, you're going to have to do the same thing. And there's not a good way to even it out. If you say, well, we spent a ton of money on dental or health benefits for this employee, and this employee got nothing, and the company had to pay for you, my partner, all your dental stuff. And other owners like, well, I want some money in my retirement account to even that out. You can't do it. You can just pay one of the other ones more. You just pay more wage, essentially, but that's it. And that's not an efficient way to do it, as he knows, which is why he's getting these questions, I think.
And Nathan, we could come up with some ideas here, thinking outside of the box with you. But again, just like Suzanne's last question, some of these questions we can answer, they're quite targeted. There's a clear-cut answer, yada, yada. This one is very fact intensive based on your situations and ages and what's going on and IRAs. How long has this full-time employee been with you? How long are they going to be with you? Are there some workarounds we could get creative with? That's what we knock out. And I think in a half hour to an hour again, a lot of this can be dealt with. And when I say corporate reorg, we're talking about setting up 2 new entities. We're going to keep this S-Corp, give it to one of you partners, set up a new S-Corp for one of the other partner, and then merge them in as owners to a new LLC that's going to start January 1st, 2021. Now, yeah, you got to make some changes, banking, merchant accounts, some website shopping carts. I get it. It could be a pain for a month or so as you kind of reorganize your relationships with vendors and customers and banking. But in the long run, you're going to save thousands. And I hate to see what you're paying each other in salary. I bet you it's off. So we got some self-employment tax issues here. I could just bing. Mm-hmm. So I've got one last axe to grind on a question I got from a good friend in a vehicle last night when he dropped me off at my house. And I'm going to throw that out as my last question. Do you want to choose one last one, Matt?
Yep. We need to wrap it up. So I'm on my last one here too. This was from Nick, who's has got 2 questions here. They're both quick. So he said, can you add Inc. to your business name if you make it an LLC? No. Okay. Weird, odd question. Okay. Yeah. So corporations, when you set up a corporation, like an S-Corp, for example, which is a corporation at the state, at the end of the name, you have a few options of what you call it. Corp, company, actually, Inc., incorporated, corporation. Those are all monikers in the corporation context that you can use.
I think limited, LTD can work depending on the state.
For LLCs. Yeah.
You can't, and you can use LTD in a corp or an LLC?
I think you can use it for limited for an LLC. LTD, I thought was LLC exclusive, but maybe corp.
Okay, all right, fair enough. Yeah, and you know what? Matt nailed it. I was just trying to see whatever Matt does, I have to try to, up my game to the next level. Yeah. But the fun thing is that Matt said is that list, you're going to go to the state and they're going to tell you what your monikers are.
Yeah, and it's in the statute. They might not tell you, but it's in the statutes. We obviously know it. But the common one would be Inc. at the end of a corporation, or a corp, or maybe you're a professional corporation and it's PC. That's for professional corporation. But adding the word Inc. when you're trying to set up an LLC, like Kohler Inc. LLC, is going to be any state is going to be like, what the hell is this? Like, what are you trying to do? Which one are you? Yeah. Because the company name has to designate between the two. So an LLC could be limited. It could be LC instead of LLC. You can spell out limited liability company. So there's different things you can use for either one, but you can't use both if you're trying to do an. Don't use Inc. if you're trying to do an LLC. All right. Now the next question is a good one. He says, I work a day job, excuse me, and contribute to a 401k and HSA. While making small business with my side hustle, what is the maximum I can fund with my 401k and HSA from my side business and my day job? All right. Now, if you have an HSA already, HSA is just on the individual or family level. This is not going to have anything with regard to your company or your side hustle, day job, doesn't matter. You've got qualified for an HSA because you have a high deductible plan. If you're individual, the amount you can put in, and this is, I was just pulling up my article on Entrepreneur that has the 2020 limits, 3,550 self for individual, 7,100 family. For 2021, it goes up to 3,600 individual, 7,200 family. The side business, day job doesn't matter, okay? Those are the maximum contributions you can put in for those years. Now 401k is a little different.
Yeah, before Matt mentions the 401k, a good concept here is the HSA contribution limit. Let's say it's 7,100 in this example. That's the contribution limit. That's not the limit on the number of HSA accounts you can have. So you might have 7 HSA accounts and you put $1,000 in each one. So that's why the side hustle day job doesn't matter. If you have a day job and they put $2,000 in your HSA at work, cool. That comes off your 7,100. So now you're down to 5,100. So you can open another HSA and put 5,100 in it if you have the qualifying policy, which if your company's already putting money in, you obviously have the policy.
Yeah.
But just think of 7,100 as your contribution limit, but you could actually have 2 to 3 different HSA accounts depending on where you want to invest the money or how you want to access it.
Yeah, great point. Okay, 401k, next question. Now, we're assuming you have a 401k at the day job, which you can put in 19.5 as an employee. Now, it's the same limit for 2021. 2020 and 2021 are the same for the employee part. 19.5 is what you can put in as employee. Now, your company may do a match. Maybe they're putting in 3% of your salary, and you make 100 grand, they're throwing in an extra 3,000 bucks. Okay. That's, now you're up to, what is that? 2250, 22,500. Well, the total contribution you can put into a 401k, and this includes solo case, it's 57,000 for 2020, 58,000 for 2021. So you've got another 30, I don't know, what is that? 35,000 plus that you're able to throw into the 401k. Now your company, the day job's already maxed out what they're throwing in. They're only going to throw in a few grand. So you want more? Do the solo K in your side business, and you can max out employer contributions over there. Just do 25% of what you make up to that. If you made 100 grand in that side hustle business, company could do a company contribution. It doesn't have to match. You don't have to throw in the employee. 25% of what you made, 25 grand. Now you're up to getting more closer to the 50,000 max. Now that would be 2 separate 401ks. That's your day job, corporate America 401k, and your small business solo 401k.
And the answer Matt just gave is first base. I mean, that's stage one, because it gets rocking and rolling after that with lots of creative options. Are you married? We didn't know. So now you might throw your spouse on the side hustle for salary. And you have to ask yourself too, where is this money being invested? If the work 401k, they give me a choice of 3 different mutual funds and I'm getting 5% and their fees are off the chart. Watch Warren Buffett and read some of his material on this. He thinks it's highway robbery. So if you have a 401k at work and you hate where the money's being invested, just play in the work 401k up to the match and get out. So if Matt says you can put in 19.5, that's right, 19.5 in total. And you can have 2 401ks, one at work and one for your small business. So maybe you only play in the day job 401k $3,000, get the match. So now you got $6,000 sitting in there. You just doubled your money. Good.
Right.
I don't care if it's in a mutual fund. You just doubled your money. That'll make up for a lot of fees. So put in your $3,000, get the match. Ooh, I can still put in 16,500. Yep. I'm going to go over to my small business and do 16.5 there in my solo 401k set up under the special at KKOS this year, this month. And you set up your solo 401k. Did you notice that little plug, Matt?
Yeah, I like that. Yeah.
Okay.
Thank you for.
So you set up your solo 401k at our office, put in your 16.5. Now you're off to the races on the match there. And if you're the only employee, you can start doing bigger matches than this little 3% piece of crap thing you're getting at work. So, and then we open a whole new world there. How much do you want to put in? And should I really do 57,000? Remember the principle at the beginning? Just because I can bench 225 doesn't mean I need to do it. I could hurt myself. So
Right.
That's the same point. You could put in 57,000, but you might hurt yourself with FICA tax. And it hurts. There's no Ben Gay for that. I mean,
there isn't. You can't just ice that FICA tax and make it go away. It's
Dude, that was awesome. That was sweet. It's 1-2 punch. Let's call it 1-2.
I like you brought that all the way back from the beginning. Nicely done. That's the payoff.
That's the payoff. That's what comedians do. If you're in the industry, that's what they say.
Mm-hmm.
And since I'm not in the industry, I have no idea.
Clearly. All right, okay. You got last question. You got the last question. This is for a friend.
Yeah.
Okay.
Yeah. Right. I had to. I was at the college helping with some college students last night, and my car was in the shop, so I had to bum a ride home from another professor, and of course on the way home, tax tips come up, and so that was my fare I had to pay on the way.
Okay.
No, and I love this guy. I was offering anyway. But okay, now this one I have to be careful because I can get on another rant. So I'm just gonna summarize it quickly. This professor just was up there part-time. His real business is he's I can say this. I think I'm cool with this. Optometrist. So he's an optometrist. He's got a local CPA here in this little town, Main Street, America, that's older than dirt and operating under old strategies. And I said, hey, what are you doing? How did we get on the topic? I said, okay, you get paid through this on a 1099. Yeah. And he goes, why do you care? And I'm like, so you're an S-Corp. I don't know. Hold it. You're a small business owner making $100,000 a year or more, and you don't even know if you're an S-Corp. No, I just let my accountant deal with it. People, first principle. In my opinion, this could be the biggest takeaway today.
Yeah.
You cannot rely on your accountant or lawyer, banker, insurance agent, and just say, they take care of it. No, that's how you get ripped off. That's how you lose money. And you are the captain of your ship, people. You've got to know what your first mate's doing. Doesn't mean you got to do it. You got to understand it. And I get it. He doesn't want to understand taxes, but you got to own it. You got to know enough to make sure your accountant's not a nut job. So I said, okay, you don't even know if you're an S-Corp. I go, does your business file a separate tax return? Yes. Okay. Do you get a paycheck? No, I get a guaranteed payment. Okay. Another weird word that's thrown out there. Not commonly with current tax strategies in this century. Okay, so anyway, to make it nice. So anyway, in a nutshell, this guy had an LLC and the accountant was calling his salary a guaranteed payment and everything else was pass through, passive, like a K-1 if you were an S-Corp. Is that legal? No. If he got audited, would he lose? Yes. Because on the K-1, and you accountants out there, he checked the box limited partner when he's the manager of the LLC. You can't check that box on a K1. But why did he do it? To avoid FICA on the pass-through and to get the 199A. That's the QBI deduction on the pass-through. So this accountant double dipped, and you know why he did it? Because either they were lazy and didn't want to do an S-Corp or explain it to their client, or number two, they were stupid. And in life, a lot of mistakes people make are because they're lazy or dumb. So I told him, email me over your tax return. I can look at it in 90 seconds, tell you if you're good or not. Got it within 90 seconds. I was like, you're jacked up. If you get audited, it's going to cost you. And he's like, ugh. And he goes, I hate this. And I go, don't hate it. Get involved. You could save a lot of money here. There's a lot of other stuff. This was just one strategy in the Kohler Sorensen realm. And he's like, okay, yeah. And so anyway, in a nutshell, people, I've got a workshop this weekend, Friday and Saturday, 2 full days, recorded. Join for the portion you can, get out, and you watch the recording later. You go to markjkohler.com. You can sign up right now, and you get a workbook. I'm doing some quizzes, giveaways, breakout groups, and you're going to learn the basics on Friday and the advanced on Saturday. Every business owner out there should be able to go to that workshop and at the end of the day, go, okay, I get it. Now I can manage my professional. That's it. That's all I'm asking. I'm not asking you to do your own tax return. Just know where things are generally going so you can ask the hard questions. So the point is, you got to have an S-Corp to do a salary and avoid FICA. You can't do it with an LLC. The end.
Yeah. And I say on the being captain of your own ship, you know, taxes are the #1 expense for small business owners. Once you have a little bit of success as a small business owner, you're going to realize pretty damn fast the #1 expense, which depending on the outcome of the election might increase for certain people, like business owners. You know, the #1 expense is taxes, and you've got to know that expense and how to manage that expense and minimize it. And I know everybody hates taxes, and it's not fun. And Mark and I can geek out on it, but it matters. You will keep more money in your pocket, have more money in your business to grow. You can work less if you don't have to build more income. Just keep more of what you're already making. So that's what we're trying to do here in the podcast. So hopefully you've learned 1 or 2 things from today's podcast.
I love it. Great show. Lots of fun. I want to thank all of you for coming. And I do need to give one parting disclaimer for some of the hate mail I got this last week. I covered on 2 different live webinars and broadcasts on Facebook and YouTube for Entrepreneur and our clients on the Biden tax strategy. And I got quite a bit of hate mail saying you dumbed it down and made it sound like everybody's going to pay more taxes. That was not my intention. But let me say this. On the 12 points of his tax plan that I thought could be considered negative, and I gave 4 points of his plan that were positive. I tried to be as not bipartisan as I could. On the 12 points that were bad, it is true. About half of them only affect those people making more than 400 grand a year. Totally. And I could have been more clear about those certain ones that really only affect you if you're in the high income net worth type scenario. But the other half, they affect small business owners. And I got a lot of hate mail going, I make less than 400 grand. Biden's not going to hurt me at all. Oh, really? Did you know that he wants to repeal the entire Tax Cuts and Jobs Act, which helps small business owners? He wants to do this. He wants to do that. And those things affect every small business owner. So is he going to increase your income tax if you make less than 400 grand? No, he's not. And I never said he was, but I could have been more clear about it. So I want to say thanks to all of you that were willing to put up with me. I wasn't trying to take a shot at Biden and do any misdirection, but I could have been more clear on that. So there are items that are 400 grand or more. There's a lot of items that aren't. And we'll see here in the next few days if it really even matters. Yeah. So, Matt, I'm done. Take us out, baby.
All right.
What would you say?
Okay. Thanks so much, everyone. And thanks for always sending in the questions. Get to Main Street Business. We do the open forum every 3 weeks. You can write in your own questions. If you need more in-depth consult, some of those questions we kind of mentioned some examples, gave some basic ideas, but reach out to our law firm, KKOS Lawyers. And of course, we're here to help you at Directed IRA with your self-directed account needs, Kohler CPAs, Mark's CPA firm, for your tax return needs. We just want to be here if you need us, but at a minimum, just keep staying tuned to the podcast. We'll be educating you to help you be the captain of your own ship. And also, lastly, please subscribe to the newsletter, because we are sending out lots of information, updates on the shows, what you may have missed. Mark and I are writing articles constantly trying to get more information out on how to better live the American dream.
Yeah.
See you next week.
Thanks.